What's up, everyone? Welcome back to the Dentist Who Invest podcast, one of the first podcasts of the year with a familiar face, a man who's becoming a familiar face in the podcast, Bilal Ahmed, and he is here to share today the best ways that we as dentists can invest in limited companies and how we might direct the ownership of our practice. Should we do it as a sole trader? Should we do it as a limited company? All of this and more to be found in this podcast. Bilal, how are you today?
I'm good, James. Thanks for having me on. Happy New Year.
Happy New Year to you too, my friend, and thanks for penciling us in because this is tax season. Season spelled SZN as they do on the internet forums, or at least that I've seen anyway. And I know that you're a very busy man, so thank you so much for that. So Bilal, for those who don't know you, I know that you've been on the podcast a few times, but maybe a quick intro, who you are, what you do for people who have yet to familiarize themselves with you or people who haven't seen those episodes.
I appreciate that, James. So my name's Bilal. I'm Chief Accountant at Heathhill Green. We specialize in dentists and dental practices and the whole dental journey, really. So from brand new associate all the way to practice ownership and exit on your investments. But we deal with people across the entire life cycle of dentistry, as I like to call it.
10 out of 10, top stuff. So Bilal, we're talking about limited companies. Limited companies are a little bit like black magic to some dentists who may not necessarily have had the time to educate themselves. Maybe you can set the scene on what we're going to talk about today, paint a picture that's really simple, break it right down, pretend like you're explaining it to someone who has no experience on finance whatsoever.
So what we're going to talk about today, James, is a popular question. So I'll give you a bit about my background. So my background is corporate accounting, so not sort of traditional tax season accounting. Mine was very much, if you're not adding value, what are you doing as an accountant? And the way we work is because we get to see what you're doing in real time, we then make suggestions. So we will never give you investment advice. That's not what we do. So we leave that to the professionals. We leave that to the financial advisors. What we'll do is talk about the structure, what you can and can't do, or more importantly, how you can do it more efficiently, because the more tax you save leaves more money behind to invest. And that should ultimately, exactly. Tax planning, there's an entire industry based on that. So that's what we do. And that's what we're going to do today. So we're going to talk about not just limited company, but we're going to talk about both sole trader and limited company, because as we all know, limited company isn't always the right option for everybody. The biggest thing to consider within, obviously, is superannuation that says the pension scheme might be the reason that you don't want to do it, but it's different strokes for different folks. But we talk about both aspects and the journey being the same, and we're going to look at it from both angles.
Cool. That sounds really good, and I'm sure there'll be lots to learn on today's episode. So Bilal, let's start from the start. Seems logical, seems reasonable. Put it simply, how should we set up?
Cool. So it really depends on how you're set up currently. So if you're currently a partnership or a sole trader making loads of money and you can't operate by a limited company, then it's how do we move your money after you pay tax to investments? Now, one thing that we want to talk about here is what you invest in to generate wealth or grow is different to what you invest in your business. So we get something called an annual investment allowance. So when you go buy a new iTero scanner, a new x-ray machine, things like that, they are classed as investments in your business and they are tax deductible. When you now want to do stocks and shares, property, or sort of new ventures, that kind of thing, you have to account for your tax first. So if you're a sole trader or a partnership, you pay whatever rate of tax you're paying. So if you're earning over 150K, you pay your 45% tax, and then you're left with the money to then go invest in. And then structure beyond that is obviously limited company being a very popular option at the moment. Is once you've accounted for your corporation tax, you've taken out your dividends, what's left in the business. And we go through that in a lot of detail in our previous podcast. So we're not going to sort of languish on that point too much, but it's a case of be efficient. Don't take all your money out of your limited company. What do you do with the amount that's left? If you've got no desire to invest in your business and just take all the money out every year, then a limited company is probably not the right option for you. So, but this is very much dentists who invest. So I think this is geared towards a very key demographic for you.
Yeah, so I always think there's a bit of an illusion that investing in your limited company is always the most tax efficient way to do it. It's not always, is it? And quite oftentimes, probably for the majority of people, it's actually cheaper. It's actually more tax efficient to get it in your personal accounts and then invest through an ISA, SIP, GIA, whatever you plan to do. Because let's not forget, when you're investing through a GIA, general investment account, you've got your 12,300 capital gains allowance completely tax free, and anything that is in an ISA up to 20,000 in an ISA, yeah, you get taxed on the way in beforehand. But if your tax rate is the basic one, then it's going to be 20% plus your plus your national insurance, which isn't too far off corporation tax anyway. You know what I mean? So again, just as you said, we're not going to languish on it too much. Let's just jump back to those that are interested in limited companies. What sort of people should be looking at investing through a limited company? People with a lot of money in a company that they can extract, just like you said. Just a quick brief summary of those sorts of people.
So let's talk about that then. So with the type of people that want to invest in a limited company, I think you hit the absolute nail on the head in that in your previous statement. There is, if your goal is to take all the money out of the business, whatever you invest, you need to live off. The limited company is probably not going to be the best way to do it, because first you've got to pay 19% corporation tax on the returns on your investment. Then you've got to pay your dividend tax, which is, if you everything we assume here is going to be at the higher rate dividend tax. So you're either going to pay 32.5% or 38.5% dividend tax, which is over 50%. Whereas if you did that as a sole trader and you suffer the tax on the way in anyway, is you would then pay capital gains tax at a low tax rate. So you would either pay capital gains tax at, well, we're going to assume the higher rate. So you pay capital gains tax at 20% on anything over 12.3K. So from how you want to extract your money, that really governs how we set you up in the first instance. The second bit to consider within that is what do you want to do long term with all of that? And then the type of investment always is really important. So I think this is a man after your own heart. Crypto. If your investment's got the ability to go 10, 20, 30x, let's use Bitcoin as an example. Over a year, it went from 3K to nearly 60K. So at the start of lockdown to the end, it nearly, what did it peak at? About 60, 65K?
Yeah,
making that number up.
It went up to about 64K in end of February time. Of course, as of today, it's right back down to, I believe it's 40 off the top of my head. Yeah. But yeah, highly volatile. But yeah, this is the thing. If Bitcoin did let me just do the math in my head, and over a 20 times from the start of lockdown to the beginning of February. So yeah, definitely a explosive asset, highly volatile. And that leads into, just before I jumped in there, you were about to go somewhere with that.
Yeah, so let's talk about the tax on that. So let's say you were going to buy a whole coin. Look, hindsight is a great teacher, but let's say you took out 3K at your limited company and paid the tax on that. 19% corporation tax is paid. You then paid your 32.5% dividend tax. You're now left with a 3K to go invest in Bitcoin. That's now gone 20x. That's now worth 60K, for instance. That's now worth 60K. And if you wanted to cash out, you cash the whole thing out. Your gain is now 57K. Your first 12.3K is tax free, and then you pay 20% tax. So overall, you're far better from a tax perspective in that scenario than if you'd done it through a limited company. Because if you did it via a limited company, depending on your asset classification, you have to revalue your assets every year, and you pay tax on the revaluation whether you've liquidated or not. So if your on paper valuation has grown by X, then you pay tax on that 57K at 19% corporation tax before you've even taken it out.
Yeah, there you go. Yeah. So it's not always,
not always.
People would assume that it's cheaper.
Correct. So if your goal is quick flips, immediate gains, then it's not worth it. If you're looking for a longer term growth and exit strategy, then a limited company is a more tax efficient structure. So before we jump on, is there anything you want to add in that?
No, all makes sense. And I believe as well, from my conversations with accountants and people in the finance world, it can also be advisable, not just if you're playing the long game, but let's say you have a huge lump sum of money in your business and it's going to be really tax inefficient for you to withdraw that into your personal account, then that can be another instance, if I'm correct.
Yeah. Correct.
Absolutely.
So the word we use for that is reserves. So if you've built up loads of reserves, so just give me a second, I just need to mute my...
Totally
if
cool.
You've built up, yeah. So yeah, give me a second. I just need to mute this.
Yeah, that's all right. No worries, my friend.
Yeah, we're good. Cool. So reserves. So if there's loads of cash built up in the company, what do you do with it? It can be massively inefficient to take it out, but we are going to cover that as probably one of the final points today. And we talk about that on exit and what that looks like. So if you've got masses of cash reserves built up, what is it? What can you do with it?
Okay, awesome. Brilliant. So this leads very nicely into us having a little bit of a conversation about the vehicles that we can use within a limited company, because they are much less known. So when we're talking about personal accounts, there's only three main ones anyway. There's a SIP, there's an ISA, and there's a GIA. So what are the equivalents in the limited company world? What should we know about?
So a SIP is, so you can still invest in a SIP by your limited company, but it goes to you as the person. The company doesn't have a SIP. One thing to note when we talk about a limited company and a sole trader is a limited company is a separate legal entity. So as a separate legal entity, it can't have an ISA. So a limited company can't have an ISA. It can't have SIPs or anything like that, but it can invest in them on your behalf, and it's a tax efficient way to pay into your pension on your behalf. So it's a really good way to extract money. But for today's perspective, I think one of the most popular questions I get asked is, what do I do with my money? How do I divest? So we're going to look at 4 different asset classifications. Now, these aren't by any definition of asset classification. This is just how we're going to break up the conversation. So the first is we're going to talk about buying into a practice or setting up a practice. So we'll talk about growth. We're going to talk about buying rental properties. So we'll talk about divesting altogether. We're going to talk about stocks and shares, how you invest in other companies. So we talk about passive income. And then we're going to talk about crypto, which we've already touched on, but James, you'll be the man leading the way on that one.
Awesome. Looking forward to it.
Good man. So if we jump into buying a practice now, I mean, you could probably give me some more flavor on this. How popular do you think this is as an option for most dentists today?
Diminishing, but still on their radar. I don't have any figures. Maybe that's a poll that we could make at some point on Dentists Who Invest. Who would like to buy a dental practice? Anybody who among us who has never owned a practice would still like to buy a dental practice in 2021? There's an interesting poll in the making. I would say anecdotally, maybe 10%, 20% of associates around about my age group, 30s, late 20s, would be interested in doing that. No hard figures, but there's a poll in the making.
I would agree with those numbers. So certainly from our client base, we see that sort of percentage where it's, I think statistically, it's something like, I think it's 1 in 30 will go on to make something like $250,000 a year. With that 1 in 30, it can be a mix of a really specialist associate or a practice owner. Yeah. Now, practice ownership is becoming, well, I say becoming, from our client base, it's about 20% that do want to make that step. Will they make that step is a different thing altogether. And then within that is what type of practice will they buy? So if you're like our friend Jabir, he will not touch an NHS contract with a laminated barge pole. So and I think that's becoming a more popular way to go. I mean, I put out a poll on my Instagram recently asking, would you consider opting out of the NHS at some point? So if you're a dentist, an associate dentist at the moment, stepping away from NHS, would you then make that step into NHS acquisition? It's unlikely. But would you still set up a squat practice or a boutique clinic that specialized in a range of private treatments? That is proven to be really popular, especially right now through a limited company where you get the super deduction, where any investment you make in your practice, where historically you would get 19% corporation tax relief, that's been uplifted to 24.7%. So you're getting a tax deduction of 24.7p on every pound you invest in your practice. So that's becoming a really, really, really attractive option at the moment. And that's certainly a path that we're going down. So my wife's a dentist. That's the path that we're going down. So we tried to buy an NHS practice in 2019. The numbers didn't sit well with us. And then sitting back and having a look and saying, well, is NHS the way we want to go? Can we create a brand on the back of that? Probably not. But it would have been quite helpful during COVID. But that's sort of unique circumstance. So we don't go through that. So what we're going to look at then is buying a mixed practice, because if you went purely private, then you just do the latter part that we're going to talk about. But for balance, let's talk about purchasing a mixed practice. So when we're going to talk about a mixed practice, we're going to talk about three components with it, or 4 components within that, which would be the NHS contract. It's the private revenue based on the back of that, plus the goodwill. Generally, those 2 numbers intertwined, because you can't value the private element, but you can value an NHS contract because sort of it is what it is. And then you get the land and buildings. So if you're acquiring the freehold of the property as well via mortgage or loan, however you're buying it, those are generally the components you're buying. So you're buying the NHS contract, you're buying the private goodwill, and you're buying the land and buildings, the freehold. So if you were a sole trader today, or if you're an existing dental partnership and you want to buy another NHS contract, you can either buy the whole thing and then continue to run it as a partnership, and then you pay tax at the higher tax rate for anything you extract over 150K. However, from an investment perspective, you can treat that acquisition as in its individual components, because your biggest hurdle to overcome is the first bit that says if you're an existing NHS practice owner, you're already maxing out your superannuation contribution that you can pay into your pension anyway, so you get tapered relief on the back of that anyway. So would you then buy your second practice as a sole trader or partnership? Probably not. It's less attractive at that point. The second hurdle to overcome is whether the PCT will even let you buy it as a limited company, because and if they do let you buy it as a limited company, they might suppress the UDA value. So if they then suppress the UDA value, you've now got to reevaluate your numbers to see it's even if it's worth buying, and is it worth buying at the rate that you agreed it at? The seller's less likely to remove their price because you're trying to buy it through a limited company, because that becomes your problem, not the seller's problem. So if let's come back, let's say the PCT say, no, we're not letting you buy it as a limited company. You can still you can work with your lender to buy it as separate components. So you buy the NHS contract, and you run that as a partnership or a sole trader, and you pay your rate of tax on it. You buy the private and the goodwill through a limited company, and you buy the freehold of the land and buildings through a limited company as well. Two separate limited companies, and we'll go on why the separate limited companies when we talk specifically about rental properties. But that's three separate components that you can now purchase. In this example, if it was, say, a practice generating £500,000 profit, and let's say that was split 50-50 between NHS income and private income, that's 250 going to your sole trader account, of which you're paying 45% tax because you're earning over 150k. That's 250 grand going into the limited company now. And in that scenario, instead of paying 45% tax on the private income, you're now only paying 19% corporation tax on the private income. And that's a cash saving of about 65 grand. And that leaves more money left over to pay to subsequently invest in other ventures. Subsequently, the limited company also owns the land and buildings, which it now gets to charge rent to the partnership or the sole trader into, and the partner and the private element. So that's now rental income going into your rental property portfolio, which is now also attracting 19% corporation tax. So you're creating these little pockets of investments just from one acquisition, which then says, if James now wants to go buy subsequent properties, you just buy that through James Martin Properties. If you now want to set up a squat practice somewhere that just does Invisalign and cosmetic dentistry, you've got the reserves built up into the dental limited company, which you can use the funds to go do that. And then with that, there's other considerations. There's legal considerations, there's CQC registration considerations, because you're running two separate practices under one building. So the private's considered its own practice, NHS is considered its own practice, but you've now got to split them up that says they are treated as separate businesses, separate CQC registrations, bit of admin that goes around it. But for 65 grand, I'm sure we'll find a way.
That is so clever. How common is that setup?
It's fairly common on entry. So this is what we do. I mean, this is what we eschew. I'm quite evangelical about this. Is if you speak to your accountant ahead of time, it's very easy to set up. You work with your lenders, you work with a buyer. It's all quite easy to set up. However, if you bought it and then want to try and undo it, it's quite expensive, and it's probably not worth doing it that way. And then if you're an established practice, there's so much to consider if you're trying to then make those changes in real time. Because if you're now an established practice, you want to make a sale, you've got to buy, the taxes and capital gains that you'll incur can become quite expensive. But the first step you can take is splitting out your private and your NHS income, and that is open to most existing practices. There's just some work that has to be done around how you transfer some of the costs, like overhead costs, for instance. Like how do you recharge your nurses over to how do you split your revenue, your overhead costs according to the split between NHS and private income. So a bit of admin that goes in the back of it, but we are working on an example at the moment, and I quite enjoy these kinds of things because it's mental arithmetic, and it's quite fun.
That's awesome. Okay, cool. Anything else you'd like to say on that, or shall we move on to property?
So one thing I want to talk about just before we move on to that is when you've got that set up. So let's say you've gone into this setup, you bought your practice, you now got your three individual components. If you now want to sell, and let's talk about exit, is if you want to sell the NHS contract, you can. If you want to sell all three components, you can. If you want to sell each individual component, you can. So you could sell the private separately, you could sell the NHS contract separately, and you can sell the private, the land and building separately. Or if you've come to the point in your career that You now want to live the passive lifestyle, and you've generated enough wealth to now use that wealth to do what you want. You could keep the land and buildings, still charge the new owner the rent for the building, and they would buy the NHS and the private portfolio off you. So this is where it becomes quite tax efficient on the other end, because if you were to do that for the limited company, you'd only pay 10% on 10% tax on liquidating shares. You would pay your capital gains tax on selling an NHS contract. You haven't sold the property income. When you're doing things like that, is if you were going to sell the private element, the private limited company back to whoever was going to buy it, and claimed entrepreneur's relief, you can't go back to that trade within 3 years.
Right. Okay.
So these are all really, really important things to consider. But I think that sort of draws a line under that one that says whether you're currently an NHS whether you're currently a sole trader or currently a limited company, those options still exist to you, because if you're currently a limited company and you've got all these cash reserves built up, you can use all of that to buy it. If you can't buy all of it, you can buy the individual components. If you're currently a sole trader, you can, again, do the same sort of setup. You've just got to split everything else out.
Right. Awesome. Super interesting. Okay, cool. So I believe the next thing we were going to segue into was property.
Yeah. So property is really, really straightforward. So there's a post on my Instagram about buy-to-lets and the tax implications of investing into a buy-to-let. And again, we're assuming everyone's a higher rate taxpayer or intermediate rate. So not the basic rate, not the 20% rate. So we're either looking at 40 or 45%, but for simple math, we'll look at 40%. So if you're currently, if you're looking to invest in a buy-to-let property and you go buy it in your own name, so James goes and buys a rental property generating £10,000 a year in rental income after expenses. Expenses are sort of minor for things like maintenance, insurance, legal fees, things like that. You can no longer claim your interest as an expense.
Right.
So if your mortgage payments, and we're talking interest-only mortgage, if your mortgage payments amount to, let's say, £5,000 a year, historically, it'd be £10,000 worth of profit, £5,000 worth of expenses, and then you'd pay tax on the other 5K. So the tax on the other 5K at 40% would be about £2,000. However, you can't do that anymore. So what HMRC say is we're going to tax you on the whole 10K, regardless of the interest payments now. So you'll get taxed on the whole amount. So it's 40% on the 10K, which is £4,000. Then you get a 20% flat rate relief on the interest payment. So in this example, so you've got 4K tax, your interest payments come to 5K, you get 20% of that is knocked off your taxable, so you pay 3K in tax now. So it's cost you £1,000 a year more to run it that way. Whereas if you had bought that same property via a property limited company, the company can claim the interest as an expense. So straight away, we're now comparing tax on 5K as opposed to 10K, and the company only pays tax at 19%. So that's more cash left over. I've got a detailed example on my Instagram, which is @Green if anybody wants to check that out. But fundamentally, that exists. So limited companies can claim the interest, pay low rate corporation tax. Sole traders can't. Now, within that do you need to live off the income? So if you need to live off the income, then it's probably not going to be worthwhile, because you're paying 19% corporation tax, then you're going to pay 32.5% dividend tax. So 51% versus the 3K, odds and sods, it's not going to be worth doing. Buy it in your own name, it's fine. If you look at the longer term strategy, and this is what sort of my wife and I do, as isn't to live off the income, as is to live off the income when we retire and have something to pass to our kids. Because property prices are only going one way, and it's getting it's getting harder and harder to get onto the ladder, and we don't want our kids to face that position. So we will hand that to our kids, which will go on how we do that at a later date. So our strategy is not to have the rental income to live off now, but it will be at a later date. So at a later date, theoretically, we'd be under the 50K threshold. So our dividend tax on that would only be 7.5%. So it's worth doing at that point. So just sort of go back a step. If your goal is to invest in property and live off the income, do it in your own name. If your goal is to save for the future, then do it via a limited company, because then any proceeds you're now generating at the lower tax rate, you can now reinvest back into your business and buy subsequent properties. Furthermore, if you're a limited company and you've got reserves, you can loan the buy-to-let company the deposit to buy subsequent properties, and that's what you do with the reserves. So James Martin Properties will owe James Martin Dentistry or James Martin Crypto King the deposit amount, and that's how that money moves back and forth.
How did you know the name of my limited company? I'm joking.
if you're currently a sole trader and you want to invest in buy-to-lets, then again, set up a limited company if that's the way you want to go, and you can loan the money there. And let's say you loan the buy-to-let company 50K and you want to take 50K back out. That's a loan repayment, not income, so you don't get taxed on that. So that's quite important.
How do the terms on that work then? Can you loan it to someone indefinitely, or does it have to be some sort of minimum repayment by law?
So it has to represent market terms.
Right.
So it's something called an arm's length transaction that says if James is going to loan me money, it would have to be on the same terms that James would loan himself money. So it's referred to an arm's length transaction. So it has to represent market terms.
Okay, so Bank of England base rate?
Yeah, plus or minus a couple of percent, yeah.
Awesome.
So why you would have to do that through a separate limited company is more from a risk perspective from the lender. So it's not because we want to charge more fees. It's mainly because from a risk perspective, a lender doesn't want to see any other trade going through that. So if you were to buy it through your dentistry limited company, a lender will see that as too high a risk because their investment could be put at risk by any sort of litigation or anything like that. So they want to see a separate limited company which has no other external forces against it, which they would then lend against. So that's the only consideration when setting up, when looking to invest in properties via a limited company. It has to be a standalone limited company. And for those of you wanting to Google it, it's an SPV or a special purpose vehicle.
So Bilal, all this talks about stocks leads us in very nicely to where we outlined this conversation is going to go next. And that is, of course, how we might invest in stocks through our limited company.
Cool. So it's a really straightforward process. So where previously there's quite a bit of complexity with SPVs or how you purchase a practice, it's actually dead straightforward with stocks and shares. Your account just has to be in the name of the limited company. So if you've got these masses of reserves and you want to start investing in other companies, you can use the assets that exist for that. The reserves that exist to buy those assets. So if you're buying stocks and shares, dead straightforward. The account just has to be in the limited company's name because the limited company is the person that owns the wallet, the exchange, the account, and you can go and invest. So there's no restriction on the things you can and can't invest in. It's just the companies that will, you might be restricted on the companies that will do it for you. So, but your mainstream ones, you shouldn't have any issues doing that with. But then the way, again, with limited companies, how you measure the value of an asset classification is you have to be consistent across all the assets. So you couldn't say, well, I'm going to treat these ones differently to these ones and these ones differently to these ones. So if you want to, if you revalue your assets every year, revalue investments, and if that investment's gone up, then you pay corporation tax on the gain. If it goes down, then it offsets your corporation tax you've made elsewhere. So you could be quite smart with it that says, well, if my business had an absolutely astounding year, but my investment portfolio has actually taken a bath, you could offset one with the other.
That's awesome. And it's important to mention as well that would only occur, you would only pay corporation tax if you crystallize the gain. I'm glad I asked that then, because that changes things.
It does change things. So this is what I was saying about when you treat an asset classification. So if your treatment on asset classification is, I will revalue my assets on disposal, then you value them as and when you come to sell them, but you have to treat every single asset that fits that classification the exact same way. Otherwise, if you say for tax purposes or for business purposes, I want to revalue my assets every year. Now think about growth, think about trajectory. Think about if you've put £10,000 down in an investment, it's now worth £1 million. You now want to borrow against that. The lender's going to want to see your balance sheet showing that £1 million asset. Therefore, you have to revalue it. Now, if you then revalue it, then you've made a gain, which then has to be factored into your tax calculations.
But then would that not mean that if you own a property through a limited company, that if the property's value appreciates, that you owe corporation tax on the amount that it's appreciated by? Is that correct?
You made a gain, yeah. So, which is why SPVs come into hand. You don't revalue your asset.
Right. I'm learning so much today. This is gold dust. Yeah. Awesome. Okay, cool. Anything else you'd like to say about stocks?
Again, it goes back down to what your goals are. So if you're betting on Tesla, and I say betting's not the wrong word. If you're investing in Tesla and you're expecting it to gain to take the money out, then think about it on what the potential growth is, the volatility, what your investment strategy is. Because if the gains far outweigh the initial tax hit, then you're better off taking the money out, investing into it in your own name. But again, it all depends on what your strategy is.
Wow. So something to think about,
Yeah.
110%. We said the C word a few times, crypto. How would you advise investing in crypto in a limited company? Anything we should be aware of?
Yeah. So just debunks. This is not advice. This is how, not advise on how. So just
Yeah,
sort of
sorry.
protect myself there.
Yeah.
So
Not trying to
crypto's
incriminate
a
you. Sorry.
crypto's a really interesting one. Mainly because the potential gains on offer are far more tax efficient to pay the personal tax on them. Now, if you're going to be, let's sort of take a step back here, because crypto was the last one in the structure. So what we'll talk about is risk. Whatever you invest in personally, if it goes the other way and you leverage the trade against it, you're liable for that, for the other end of it. Now, if you did it through a limited company, a limited company is a separate legal entity to you personally. Therefore, if that limited company starts racking up loads of debt, it's the company that's liable for it. Yeah. So it's terrible. But if you started doing some very risky bets on crypto and you went the other way, and it was via a separate limited company, you could just shut down that limited company. It probably will impact your ability to act as a director for other companies. You might get disbarred, but then your other assets are still protected. And that's the way to look at it. And we're going to go into that in a bit more detail as we wrap this up. But crypto is a really interesting one. So if we use the example of Tesla that bought a boatload of Bitcoin, when they made a gain, it increased their corporate position, because they had all this money that made their balance sheet look better, because they've made all these ridiculous gains on crypto, and then they started liquidating their position. They sold a little bit, but then all that is then taxable gain. And conversely, if it went the other way, it would have reduced their tax position. But it really depends on what your goal is. If you're just going to hold and sit on it for forever, if you're trying to buy penny crypto and see where it goes in 10, 15 years, buy it in your own name. The CGT position is far better than the corporation tax position, because you paying a minimal amount on you paying 32% dividend tax on a very small amount of money that could potentially go 20, 30x is far better than doing it through the limited company, saving the 19% corporation tax, then taking it out.
Yeah, I hear you. Question, Bilal, as well, because of the crystallized gain thing, would that mean that you have to revalue your crypto every once in a while? Does it not work like that?
No, for personal tax it's different. So companies don't pay capital gains tax. Companies just pay corporation tax. There's no capital gains for a limited company.
Oh, sorry. In case that wasn't clear, I meant within a limited company. Yeah.
So it's crystallized gains. It's gains as revaluation, depending on what your position is. If your internal policy is only revalue on disposal, then you would pay the corporation tax on the disposal of the asset.
No, I get it. That's awesome. Thank you so much. Brilliant. Well, we're tying up a lot of loose ends in my mind today, because these are all questions that I had about limited companies. This is awesome. Anything else you'd like to say about crypto?
No, not on that. I think you're the man. You're the man on crypto. I'm very much very much a novice in that regard. So we'll park that one. There's two things I want to talk about: is different investment classifications, and again, sole trader, limited company. And I think I want to go on to structure at this point.
Awesome. Okay, let's jump straight in with that then, with 2 feet in both hands. Structure, let's go.
So when we talk about corporate structure, now, whether your entry point into the structure is either as a sole trader or a limited company is neither here nor there. But where our last podcast left, well, not the last podcast, the one where we talked about sole trader versus limited company, because the last thing we spoke about on that was structure, and we touched on it very briefly. So I want to use this opportunity to talk about it a bit more, because it was a very popular topic. Is when we're looking at a limited company, we're looking at risk. So how do we de-risk your position? So if your core business is dentistry, and that's where you make all your money, and that's where all the volatility is, and it is volatile, because it's deeply litigious, and there's external factors that could influence if someone sues you with vicarious liability and all that going on at the moment as well. So if you now start making investments in property limited company sideways, is JM Dentistry loans JM Properties 100 grand to go start buying properties. If JM Dentistry is ever sued, technically on JM Dentistry's balance sheet, there's a loan that's owed to it, so someone owes it money. Therefore, they can recall that loan if you're ever sued but then you would have to liquidate your properties to repay the loan to then pay it back. So that's where the risk factor comes in. How we de-risk that is by putting a holding company in. So what the holding company does is it owns all the shares in the subsets. So you no longer own the shares in any of the companies other than the holding company. The holding company never trades, doesn't even hold a mobile phone. We never expose the holding company to any form of risk. So when JM Dentistry makes £100,000 profit, pays its £19,000 corporation tax, £81,000 left over, that gets paid up to JM Holdings as a dividend. It then pays that down to as a loan to the property company. So if in a later date, and now let's say JM Dentistry becomes a squat practice somewhere where you've set your own boutique private dentistry, if you wanted to sell that, there's no other loans to factor in. So someone buying that will say, "Ooh, why is it owed £1 million from this?" And it's very finicky to unwind all of that. Whereas that's where the structure is. And from a risk perspective is you can then sell off individual business units, all the money always goes up to the holding company. Now, from a long-term perspective, depending on what your strategy is, I've got 2 kids. My mind is very much focused on what can I leave behind for them in the most tax efficient manner. Is any dividends now earned in any of the companies all go up to the holding company. I then extract my 50K, my wife extracts her 50K. Once my kids are over 18, I can then add them as shareholders and directors of the holding company, and I can pay for their university fees through the holding company that's built up its reserves. As I then pass on, and I decide I want to now hand over my business interest over to my kids, I sell them my shares, or I gift them my shares from an inheritance tax planning, which is a separate podcast altogether. So, but from an inheritance perspective, I'm no longer giving one of my kids 2 properties here, which has got capital gains tax implications, inheritance tax implications. If I gift it across their life for 7 years, trying to unpick all of that becomes far more difficult than just handing over shares in a company. Now, from a trust perspective, and again, this is probably a separate podcast, is I could move all my shares into a trust from the holding company, which owns all the subsets. So whilst I'm living, I still benefit from the income that's generated. Once I pass on, and then the trust is enacted. And this is where the longer term implications become really, really, really interesting. Is, if you want to close everything down, close off all the entities, and you own the shares in all the entities, and all this cash that's built up into them, you can then you just liquidate the shares. So you shut it all down, shut down everything, and then you pay 10% entrepreneur's tax, providing you meet the conditions for that, and then you sit off into the sunset with all your cash. But I think for me personally, I think that's a great idea, but I don't think that's ever done that way. Not very rarely does everyone liquidate the entire portfolio, because it doesn't make sense. I mean, I'm probably going to put out a reel about this. There was a wealthy land baron who passed, I think it was in the last decade or something. He left £9 billion worth of property to his son, who was 21 at the time and paid 0 tax. And that's why this system exists. Now, whether you're a sole trader or a limited company, the holding position could still exist, because if your holding company was the one that you owned your property company in, your crypto company, but all your income is still earned from the sole trader, it's the sole trader that makes the loan to the holding company, and then it still has its subsets. So that structure can still work. It's just, where does that initial source of income still come from? And then, so from a structure perspective, that can always work. So this is where holding companies become really important to de-risk your investment strategy, and also how to move money around between the entities, and then how to exit any one of the individual business units.
Yeah, 110%. Trusts and inheritance planning, something to get an accountant or somebody knowledgeable in finance involved in, the sooner the better. And I do want to do a podcast on either both those things together or as 2 separate podcasts at some point. So yeah, that was something I will explore. And then Bilal, you also wanted to explore, there was one more thing that you mentioned just before you talked about what we just spoke about.
So it's the fun side. It's the exciting side here now, and my view of exciting is slightly different. It depends on what you want to invest in. Now, if your thing is watches, then there's certain investment classifications that, as they grow, there's no tax due on them. So if you bought a Rolex at retail for £7,000, you sit on it for 15, 20 years, it's now worth £60,000, but you've worn it, it's fine. Once you go to sell it, no tax due, which is why watches are massively popular. Same with some vintage cars, that if it's your car, there's certain classification, there's certain criteria you have to hit. It can't be a garage quick. You have to drive it. It has to be insured, so on and so forth. If you bought a Carrera GT, for instance, now cars might be your thing. Let's say you bought a Carrera GT for a steal £250,000. You bought it for £250,000. You then sell it for 500 grand. No taxes due. Same with art. Art is NFTs and art. I'm not going to get into that, but the money laundering aspect of it. But from an asset, certain asset classifications where no tax is due, should you make a gain from a personal perspective, from a limited company, they are. So, yeah.
Interesting.
So let's talk watches. If you were to buy Rolexes through your limited company as investment pieces. As the shareholder, as the director of a limited company, you have something called a fiduciary responsibility. So you have a responsibility to look after the income, the expenditure, the assets of the company as in the benefits of the shareholder. Therefore, if you were going to go buy all these Rolexes and you needed to put into a safety deposit box, you can claim that as an expense. Any insurances, upkeep, maintenance, servicing to keep the asset in good life, good nick, you could claim all of that as an expense.
I see. Okay.
Yeah.
Good. And
So
that's why it's worth having a conversation with your accountant.
exactly, which just sort of wrap all that up. There's no one size fits all. It depends on your investment strategy, depends on what your long-term goals are, your medium-term goals are, the kind of asset you want to invest in, and your risk profile. All of that then factors into the kind of things you want to do. But ultimately, the goal for this was to say there's more than one way to skin a cat.
I love it. And you know what? So much gold dust in that podcast today. Bilal, we're coming up to the 40-minute mark. Is there anything that you'd like to say, just to draw a line under proceedings today, just to put a cap on it?
No, I think, like I said, these are very much blanket statements. If you want to know how any of this could benefit you, feel free to reach out to us. So message us on Facebook. It is my account that you'll see on the Facebook account, so Bilal Ahmed. If you head over to Instagram at Heath Hill Green, you'll find us there. We put out loads of content, loads of videos on things that you might find useful. There's a link in my bio that says if you do want to sit down and have a chat about any of this, feel free to book in. And then I think if I had hair, I'd probably lose it, but I think it's contributed to a lot of the whites in my chin. Is April's the best time to start reviewing your position. That says the tax year starts in April, so March is where you want to sit down and have a chat with your accountant, have a chat with us. Use it as a health check that says if you want to hit the ground running, and proactivity is key. Is don't do something and try to work out how you're going to undo it afterwards. Do it properly at the start, and then it makes life easy for everyone involved.
Thank you so much, Bilal. I hope tax season isn't too overwhelming, and we will catch up again very soon. In a bit, my friend.
Cheers, buddy.